Hi, and welcome back again to Option Analytics Edges and Hedges, taking a look at a new vol capture trade on Bitmine Immersion BMNR, which is a fairly new IPO and also fairly new to having options, a little over a week since the options started trading. But we saw huge volume, especially short term, in the BMNR calls. That set up a trade long term going out to January of 27, similar to what we did in GameStop and some of the other stocks back during the meme mania a couple years back, where longer term options provided what we deemed to be the best opportunity. Proved to be the case here once again in Bitmine Immersion. Going longer term, you can get a much bigger premium, much bigger level of safety, and still have a very nice potential for profit. So here's the chart on Bitmine Immersion. You can see it had that quick little spike back in July after it came public, right? Then right back down here. The options have only been trading basically for a little over a week. We can see that those options, right, started getting some big volume in, especially the short-term August options, right? Here's the Augie volume. You can see massive volume coming in, especially on the call side, right? As we continue to build, you can see 28,000 coming in on August 35 calls, the then out of the money calls. You can see that spiked the implied volatility. So that set up a couple very nice opportunities as vol shot up to what we deem to be too high a level overall, especially longer term. So let's jump in and take a look at how we took advantage of it. So this is from July 25th, right? The stock was at 39.45. The IV on that sell strangle, selling the in the money 55 put, right? It's about 16 points in the money, right? And the out of the money 65 call, right? The IV was trading almost 147 and a half, right? And believe it or not, by selling the out of the money call in the money put, you would be net short deltas. Why? Because the upward drift, right? This huge implied volatility well over 140 means that upward drift makes out of the money call delta above 50, and in the money puts, right? These are in the money, right? By a decent amount, 16 points below 50. So you get the advantage of selling a negative 52 delta on that 55 put, 65 call. And you could have gotten almost 56 points net credit. What does that mean, and why do we like this, and why is it similar to our GameStop trade from back during the meme mania a couple of years ago? We did the same trade in GameStop where we had literally no downside, right? If the stock went to zero, we could still make money. Same again here, right? By selling that 55 put 65 call at over 55 points, that means if the stock went to zero, we would still make 95 cents, right? The calls would obviously be worthless. The puts would be worth 55, but we sold it for 55.95. And then to the upside, our upside break even, the 65 call strike plus the 55.95 premium we received means our upside break even 120.95 or 81.5 points higher than where the stock closed at 39.45 roughly, or well over 200% upside cushion. We certainly like the odds on this sort of trade. All we're looking is for the stock IV at some point to settle down, which we think would happen fairly quickly. And lo and behold, that absolutely did, going to August 2nd. You can see the stock price actually dropped, right, to 31.68, but the IV, right, between the put, right, at 136 and the call at 127.30 dropped to 131, which means that IV drop was a huge benefit in our way. The delta on the trade now just minus 34. Why? Lower IV means those deltas go towards the absolute value of 0.50. So that's set up ideally for that. So that sell strangle, selling the 55 put and 65 call could have been closed out at $4.70, or a very nice gain overall. Your expected delta gain, right, on the trade having that kind of smooth delta, right, ended up being a 34 delta, right, started out being a 52 delta. So taking that kind of low 40 smooth delta, your expected delta gain on the train with the stock dropping, right, from where it was before at 39.45 to 31.68, right, that 7 or so point drop would have been expected to be about 3.5 points. Instead, we were able to make 8.25 points, $8.25 on that sell strangle, right, selling it back then at almost $56, covering it, right. The trade dropped to 47.70, so the actual gain on the trade 8.25. So even with the stock, right, moving from the where it was to begin with at 39.45, right, and then the stock dropping all the way down to 31.68, that was only a 7.7 point drop in the stock, yet that sell strangle actually dropped more by 8.25. Why? Because that IV came down, and longer term IV, a smaller move is a bigger point move on that. So overall, we would expect to make, because of the price move on it, right, $3.34. We made $8.25. So we were able to capture, right, by selling that inflated vol and then covering it at the lower vol, almost 5 points overall. Very nice trade for a very much well-protected trade. 200% upside till you get in trouble, literally zero downside, and only 9 days held. The fact that you're going out to January of 2027 doesn't mean you have to hold it anywhere near that long, right? We were just looking to IV to revert. And then interestingly enough, we took a look at a covered call trade. So here the stock was going back, again, this is on the January 29th, right? The stock closed at 35.11. That 65 call now at $17.30 midpoint, right? The IV 140-ish, right? So the covered call, buying the stock, selling that call, you would have paid $17.81, right? Paying 35.11 and getting that $17.30. And the delta on the trade, right? 100 delta on the stock you're buying, you're selling a 70 delta on the call, so you're getting a lot of downside protection, right? Only a 30 net delta on the trade. So the stock at 35.11, that 65 covered call that expired in 2027 would have been $17.81. Fast forward, right, to again Friday's close, you can see the stock closed at 31.68. So the stock dropped $3.43, right? We were long stock, short the call. Obviously, if the stock drops, the call will drop, but the stock will drop more in value, right? Normally, in this case, not the case at all, right? So the stock dropping $3.43, the call actually dropped more, $4.70. So that covered call went up in value with the stock dropping sharply. So that's the advantage of identifying these spikes in IV to take advantage of. The IV now on the call, as we said, under 127, so that drop in IV of over 13 vol points means a bullish covered call trade actually made money with the stock dropping sharply, about 10%. Why? Because we had that huge drop in IV, right? So your expected move from a delta perspective, you've been 30 deltas net long, the stock dropping 343. You'd expect the trade to be down a little bit over $1, right? But it actually went up $1.27. So we're able to capture over 2 points of vol capture, right, by identifying this expected IV drop, right, from where it was before that 140.52, then down to the 126.69, and for only 5 days held, able to get out of that trade, have a very short-term trade on some very long-term covered calls. So hopefully identifies how we go about identifying possibilities. Look where no one else is looking, right? Take advantage of the fact that IV has a bigger point effect on these long-term options. Do similar trades like we did on GameStop and some of the other meme mania stock years ago, where you can actually put on a sell strangle where the downside, if the stock drops, is zero, right? You don't ever lose money if the stock drops to zero, right? Because of the huge jump in implied volatility by the big call buying out there, and the upside well over 200% upside cushion, or a simple covered call, right? Because the options, if their short terms are being bought in droves, the long terms move up, so we're able to sell those, hedge with the stock. Once that IV starts to revert, take the trade off and move on. So until next time, as always, here's a good